Welcome to The Deep Dive, the show where we unearth the essential insights you need to navigate our complex world.
Our mission is pretty clear, isn't it?
It is to arm you with systematic understanding, help you find value in the chaos, and, well, empower you to adapt to change.
And today, we're really plunging in deep, right into the heart of global finance.
Yep, into an institution that shapes economies and, let's be honest, ultimately, your wallet.
Yeah.
The United States Federal Reserve. Just last Friday, actually, August 22nd, Federal Reserve Chairman Jerome Powell, he took the stage at that big Jackson Hole Global Central Bank Symposium.
Always a big deal, Jackson Hole. The markets hang on every word.
They really do. And Powell's speech, well, it sent a pretty clear signal, didn't it?
Seemed like it. Hints of interest rate cuts coming up. Easier money ahead.
And the markets definitely listened. We saw the U.S. stock market surge. The Dow climbed almost 2%, NASDAQ over 2%.
And the dollar dipped. Gold climbed. Classic reaction, really.
But what's really fascinating here, and this is what we really want to unpack today,
Go on.
it's how this isn't just some dry, technical economic announcement. It feels more like, I don't know, a key moment in a real-life Game of Thrones of global power.
That's a good way to put it. And it has very, very direct implications for your financial well-being.
Exactly. So our deep dive today, it's not going to be some boring economics lesson.
No, definitely not. We're going to try and unravel the really complex, often, contradictory history of the U.S. Federal Reserve.
Which is arguably the world's most critical and maybe most unique central bank.
Absolutely. We'll dig into its inner workings, try to shine a light on the bugs that are popping up in our current geopolitical landscape.
And most importantly, understand how its monetary policies have changed over, what, more than a century now?
Yeah, and how they've been deeply influenced by human philosophies, societal needs. It's all interconnected.
We'll also look at the maybe surprising differences between central banks around the world.
Because they're not all the same beast.
Not at all. And the big question we're trying to answer for you, the listener, is what does all this mean for your money? Especially in this highly cyclical, maybe losing anchor fiat world we seem to be in.
Right. Get ready for a story that's, well, as dramatic as it is informative, hopefully.
Absolutely.
Right.
And when we talk about the Fed right now, in this high-stakes environment, you just have to start with the political battles.
Oh, yeah.
It really is like watching the White House go toe-to-toe with the Fed, a power struggle, just playing out in plain sight. 1. The Fed in the hot seat, political battles, and modern dilemmas. So let's dive right into what's been, honestly, one of the most dramatic and public parts of the Fed's recent history.
You mean the Trump versus Powell situation?
Exactly. That intense friction between former President Trump and the current Fed chairman, Jerome Powell. It's been a high-stakes feud, really quite unlike anything we've seen in modern times.
And this struggle, it isn't just political theater, is it? It really highlights a fundamental tension between raw political power and the critical autonomy the central bank is supposed to have.
Right, that independence thing.
Yeah. And if we connect this to the bigger picture, it's really about safeguarding the long-term stability of our whole financial system against these short-term political pressures. That independence, it's just crucial for market confidence. 1.1, Trump versus Powell, a high-stakes public feud.
Okay, let's unpack this feud then. The friction between Trump and Powell, it started pretty early in Trump's presidency, didn't it?
It did, almost right away.
What began as, some mild calls for rate cuts and speeches. Well, it escalated pretty quickly into a full-blown public attack.
Yeah, the tone changed fast.
By March of his first term, Trump was frequently slamming Powell on social media, blaming him for being too slow with rate cuts, saying things like, everyone else is cutting rates.
And he even floated the idea of replacing Powell, didn't he? Exploring legal options for dismissal.
He did, which you can imagine caused some serious market jitters, major instability.
Right. He walked back the direct threats later, but the pressure.
It never really stopped. It was constant.
And what's particularly striking is how, direct these confrontations became.
Like that meeting in May.
Exactly. After returning to the White House, Trump reportedly met with Powell and just directly criticized the Fed for not cutting rates, said it put the U.S. economy at a disadvantage.
But Powell stood his ground.
He did. He held firm, repeatedly emphasizing the Fed's policy independence, kept saying decisions would be based on economic data, not political pressure. It was a real standoff.
And it got even more intense, didn't it? Our sources indicate that in July, Trump actually visited the Fed headquarters.
Wow, really went there.
Yeah, demanding Powell slash interest rates, reportedly from 4.25% all the way down to 1%.
That's quite a demand.
And he even hinted at using political leverage, bringing up alleged budget overruns on the Fed's headquarters construction project, like using that as a potential reason to fire people.
That's crossing a line, isn't it? That's pretty direct political intimidation aimed right at the Fed's independence.
By any measure.
Yeah. It just showed a clear willingness to push the boundaries of, well, established norms. And his actions didn't stop at just verbal attacks, did they?
No, it seemed like he suspected data manipulation was involved, too.
Right, the Bureau of Labor Statistics thing.
Exactly. In August 2025, he dismissed the director of the BLS. He cited suspicions that the Labor Department's employment data specifically might have been manipulated, pointed to a big downward revision in one period's numbers.
Which suggests, it suggests a desire to control the narrative, maybe even the underlying data that feeds into monetary policy decisions.
It certainly looks that way.
Yeah.
And he's actively tried to influence Fed personnel, too.
The recent nominations?
Right. Trump recently nominated Stephen Miller, his former economic advisor, to replace Lisa Cook, who's resigning as a Fed governor.
And Miller's known for, well, some pretty unconventional economic policies, like the Mar-a-Lago Accord.
Let's touch on that. The Mar-a-Lago Accord, for anyone who isn't familiar.
Yeah, it's this proposed economic framework Miller championed. It advocates for, well, really aggressive tariff wars, aiming to raise average U.S. tariffs from like 2% way up to 20-50%, using something called optimal tariff theory.
Wow.
And promoting dollar depreciation to boost U.S. manufacturing, and even suggesting pretty drastic measures like forcibly converting U.S. debt into 100-year zero-coupon bonds to ease debt pressure.
100 years, zero coupon.
Yep. And Miller explicitly wants to weaken the Fed's independence. He's proposed reforms like shortening governors' terms, allowing the president to directly dismiss them. It's a very clear ideological push to fundamentally change how the Fed operates.
And the whole controversy around Lisa Cook herself is another example of this pressure.
Definitely. Trump demanding her resignation in August 2025, alleging mortgage fraud.
Which she refused.
Right. And then Trump announced her dismissal anyway, which immediately kicked off a legal fight over how you interpret the 1913 Federal Reserve Act.
About the partisan reasons bit.
Yeah, exactly. The act allows the president to dismiss governors for partisan reasons, but historically that's been interpreted really narrowly, like severe misconduct or incapacity, not just policy disagreements or, unproven allegations.
So this really pushes the legal boundaries of what partisan reasons means for dismissal.
Yeah.
And what that means for the Fed's autonomy.
Absolutely.
So this isn't just some spat over interest rates, is it? It's a full-blown battle for control over the Fed's independence.
It really is.
It makes you wonder, as our listener, how do you feel about these tactics? Does it make you think the Fed needs more accountability to elected officials? Or does it just erode trust in the very institutions that are supposed to be impartial, focused on long-term stability? 1.2. The stakes: Fed independence and dollar credibility.
And that really raises the critical question, doesn't it? If the Fed's independence is compromised, if it's seen as, bending to political pressure, what are the implications, both immediate and long-term, for the market and maybe more broadly for the global status of the U.S. dollar?
Right. What happens then?
Well, in the short term, you'd likely see those forced rate cuts leading to initial market cheers, a kind of artificial euphoria.
The sugar rush.
Exactly. Historically, capital markets tend to get optimistic during Fed rate cuts, especially in slowdowns. Lower borrowing costs, they generally benefit shareholders, corporate valuations.
Right. Cheaper money usually means asset prices go up for a bit. But that short-term high often hides a more complicated reality, doesn't it?
Yeah.
What about the long game?
The long-term picture is, frankly, far more concerning. Politically mandated rate cuts, especially if they seem arbitrary, would raise really deep-seated worries about undermining monetary policy credibility.
Undermining trust.
Precisely. And that would severely challenge the market's current hope for a soft landing for the economy. But even more critically, a politically compromised Fed could profoundly erode trust in the U.S. dollar itself. Well, if its decisions are seen as serving political masters instead of objective economic data, its role as the global reserve currency, the bedrock of international trade, finance, a crucial store of value that could face a really significant threat.
So the big takeaway is short-term gains often mask these huge long-term systemic risks.
That's it.
Okay, so if the dollar's credibility gets shaken, what does that mean for our assets? For U.S. stocks, for those supposedly safe U.S. bonds, and for alternatives like gold or Bitcoin?
Well, if the dollar's status as a stable reserve currency weakens because of perceived political interference, investors would naturally start looking for alternatives.
A flight to safety, but away from the dollar.
Could be. It could lead to a significant flight from U.S. dollar-denominated assets. U.S. equities might suffer from increased uncertainty, capital outflows. U.S. bonds, traditionally the ultimate safe haven, would lose their appeal. That could lead to higher yields as investors demand more compensation for the perceived risk.
And gold. Bitcoin.
Gold, historically a safe haven and a hedge against currency debasement, would likely benefit significantly from a weakening dollar. We've seen that pattern throughout history. Bitcoin, as another decentralized sort of anti-fiat asset, could also see increased demand as investors look for non-traditional stores of value.
So the stability offered by an independent central bank is just paramount.
Absolutely. And eroding that stability introduces systemic risks that just dwarf any short-term market excitement. 1.3. Beyond interest rates, quantitative tightening, QT, and fiscal challenges.
It's pretty clear then that the Fed's influence isn't just about the headline interest rate, is it? Their power goes way beyond that.
No, much broader.
We also need to talk about quantitative tightening, QT, and how that interacts with the nation's long-term fiscal problems. That seems like a major bug in the system right now.
Exactly. The Fed's balance sheet, just for context, swelled to an absolutely unprecedented $6.7 trillion because of years of quantitative easing, QE. That was basically large-scale bond buying.
Right, pumping money in.
And since 2024, the Fed has been gradually reducing its bond holdings as part of its QT program. Currently, it's shrinking its balance sheet by about $60 billion in U.S. Treasuries monthly, and they're specifically prioritizing longer-term bonds to reduce what's called duration risk.
Duration risk being?
Basically, the vulnerability of a bond's price to changes in interest rates. They're also cutting an additional $35 billion in mortgage-backed securities each month.
So they're trying to pull liquidity out of the system, trying to normalize things. But that must have a pretty big impact, especially when the government needs to borrow so much money, right?
Precisely. The objective of QT is to shrink the balance sheet, normalize monetary policy, and by doing that, withdraw liquidity from the financial system. But, and this is the key thing, this QT is happening at the same time that the U.S. Treasury's financing needs are constantly increasing because of these persistent rising government deficits.
So the Fed pulls back, Treasury needs more.
Exactly. It creates this really complex kind of contradictory dynamic. The Fed's trying to reduce the money supply while the Treasury is simultaneously flooding the market with new debt.
And this leads us to that bigger, more worrying question, doesn't it? The long-term U.S. fiscal monetary problem, where the government's spending habits potentially just clash head-on with the central bank's mandate.
It really does. The critical concern here is whether the Fed will eventually be forced somehow to become a kind of fiscal ATM.
Printing money for the government.
Essentially, if political pressure or just overwhelming fiscal needs compel the Fed to monetize government debt to support spending, basically printing money to pay the government's bills, it fundamentally compromises its independence. And that could lead to severe long-term consequences like sustained inflation, a loss of dollar credibility.
It sounds like a dangerous path. Fiscal dominance over monetary policy.
That's the term, yeah. And it's a scenario I'll definitely touch on more when we talk about modern monetary theory later. But the key point for now is that this quantitative dimension, how the Fed manages its huge balance sheet, is just as critical, maybe even more critical, than interest rate decisions for the overall health of the financial system. It's this quiet but incredibly powerful force. 2. A century in the making. The Fed's tumultuous birth and evolution.
So to really get a handle on the Federal Reserve and these political battles it faces today, we kind of have to rewind, like way back more than a century, to its really tumultuous birth.
The origin story.
Right. But before we get into the actual history, maybe we should address some of the more, well, sensational stories that float around about its origins. 2.1, the conspiracy theory of the Fed's founding, currency wars, and beyond. You know, for years, especially back in the early 2000s, there was this book, Currency Wars by Song Hongbing, became a massive bestseller, particularly in some places.
Oh, I remember that one. Huge in China, wasn't it?
Exactly. And it painted the Federal Reserve as this, like, shadowy private central bank controlled by international bankers. You know, the Rothschilds, J.P. Morgan, designed specifically to manipulate economic crises, wars, monetary policy, all just for wealth extraction through these cycles of inflation and deflation.
The grand conspiracy narrative.
Pretty much. What's your take on these kinds of widespread, almost mythical stories about how the Fed began?
Well, look, Currency War certainly makes for entertaining reading, almost like fiction. And it really tapped into something, particularly in China after 2007, this public fascination with conspiracy theories when financial literacy maybe wasn't as widespread.
Right.
But the danger is it massively oversimplifies really complex financial systems. It just reduces everything to these crude power struggles and intrigues among a few shadowy figures.
So it misses the nuances.
Completely. And the big takeaway here is that while it's entertaining, that kind of perspective leads to a profound misunderstanding of how markets actually operate. And honestly, it can be quite detrimental if you try to use it as a basis for making investment decisions.
So acknowledge the appeal, but stick to the facts.
Exactly. We need to pivot to a more grounded, professional, historical analysis to understand the real mechanisms that were at play back then. 2.2. Early American skepticism. The first and second banks of the U.S., 1791, 1836.
Okay, so let's get into that professional perspective. America, right after independence, was basically born out of this deep mistrust of centralized power, wasn't it? Especially the whole idea of a central bank.
Deeply ingrained skepticism, yeah.
And this led to 2 failed attempts at establishing such an institution, which makes the Fed's eventual creation a really contradictory story in itself.
It does. After the Revolutionary War, the young federal government was just drowning in debt. And the currency situation, pure chaos. States were issuing their own paper money, rampant inflation, economic instability everywhere. Something had to be done to bring some order.
And this is where those famous founding fathers clashed.
Fundamentally, this era was defined by this powerful ideological clash between two giants, Alexander Hamilton and Thomas Jefferson,
Hamilton first.
the Federalists.
Right. Hamilton, the first Treasury Secretary. His philosophy championed centralized power, elite governance, a strong federal government pushing for industrialization. He proposed a national bank, modeled on the Bank of England, to unify the currency, manage federal debt, provide credit.
He saw it as necessary.
He believed in the implied powers of the Constitution, argued that if the Constitution allowed the government to tax and regulate trade, then a national bank was necessary and proper to do those things effectively. I mean, he famously once suggested a lifetime presidency that tells you something about his leanings towards strong central authority. Okay, so he was all about a powerful federal system, and Jefferson, I'm guessing the opposite.
Totally the opposite side. Thomas Jefferson, the Democratic Republican, later president, he advocated for a philosophy of strict constitutional interpretation, limited federal power, strong states' rights.
An agrarian vision.
Exactly.
Yeah.
He envisioned an agrarian society, deeply distrusted financial elites. Jefferson feared a central bank would create a financial aristocracy, basically like a monarchy, and exploit farmers through these boom-bust cycles of inflation and deflation. His famous line, "The government that governs least governs best."
And he opposed the bank constitutionally.
Yep. Said the Constitution didn't explicitly grant the federal government the power to create one. Feared it would threaten states' rights and citizens' liberties. Just two profoundly different visions for the nation's financial future, battling it out.
So Hamilton won the first round, with the first bank of the U.S. established in 1791.
He did. It started with $10 million in capital.
Yeah.
The government owned 20%. Private investors, crucially, many of them European, held the other 80%.
Ah, the foreign ownership angle. That's where those conspiracy fears came from.
Absolutely. Having names like the Bank of England, even the Rothschilds involved, that naturally fueled those early fears we talked about.
That it didn't last.
No. That structure was actually central to its demise. It functioned for 2 decades, had 8 branches, but its 20-year charter expired in 1811. Jefferson's faction successfully argued that foreign control was a national security risk. Congress rejected rechartering by just 1 vote.
1 vote.
1 vote. A clear victory for the anti-centralization crowd, but it left a big hole.
And that hole quickly became obvious, didn't it? The War of 1812 showed the weaknesses of not having a central financial institution.
Painfully obvious. The war brought financial chaos, soaring national debt, state banks issuing paper money like crazy. President James Madison, even though he'd had reservations before, signed the bill for the second bank of the U.S. in 1816.
Bigger this time.
$35 million capital. Same structure, 20% government, 80% private, aimed to restore order. But its fate was really sealed by President Andrew Jackson.
Old Hickory. He hated the bank.
Hated it, campaigned fiercely against it, called it a financial hydra. In 1832, he vetoed its recharter, And then in 1833, he took the radical step of ordering federal deposits moved out of the second bank and into what he called pet banks.
Pet banks.
Yeah, state banks chosen more for political loyalty than financial stability. A really controversial move.
So without the government's money.
The second bank just withered, lacked a deposit base, became a state bank, eventually went bankrupt in 1841.
Wow.
And the big takeaway here, I think, is how human societies tend to oscillate, back and forth between periods of free development and then needing centralized intervention. Crises often become the necessary catalyst for systemic change. This early history really shows that pendulum swinging wildly.
2.3. The free banking era and the 1907 crisis. Chaos as a catalyst.
So the period after the second bank closed, from around 1836 up to 1913, that's famously known as the free banking era. Sounds kind of idyllic, right? Financial liberty. But in practice, not so much. Not at all. Our sources describe it perfectly. A period of rampant financial instability. Minor crises every decade, major ones every 30 years. That sums it up.
What went wrong?
Well, those pet banks from the Jackson era, plus countless other state-chartered institutions, they operated with zero unified monetary policy or regulation. They issued paper money pretty freely, often backed by shaky assets, engaged in speculative lending. Currency values fluctuated wildly from state to state. It was just chaos.
Any specific examples?
Oh, yeah. The Panic of 1837, for instance, saw 90% of U.S. banks fail, led to a deep economic depression. It was brutal. This eventually led to the Independent Treasury Act in 1846, which centralized federal funds directly with the Treasury, ending the pet bank system. But it didn't solve the underlying instability of the banking sector itself.
So without a real central bank, the system was just constantly teetering on the edge.
Exactly. And it all finally came crashing down in the huge 1907 financial crisis.
Big one.
That was the ultimate catalyst for change. It finally forced America to rethink its whole anti-central bank stance. It started with highly speculative investments by these things called trust companies, kind of like today's mutual funds, using massive leverage in stocks and bonds.
And the spark.
A failed attempt by a speculator, F. Augustus Hines, to corner the market on United Copper Company stock. That led to a swift stock price collapse. And that, in turn, triggered the failure of the Knickerbocker Trust Company in New York, a huge player at the time, the third largest trust company.
And from there, it just spread like wildfire, right? A domino effect.
Terrifying domino effect.
Yeah.
The Knickerbocker collapse sparked a nationwide banking panic. Depositors rushed to pull their money out, causing runs on hundreds of banks. Nearly $300 million was withdrawn from circulation, which was a massive amount back then. Even the New York Stock Exchange was facing imminent collapse.
And there was no Fed to step in.
Absolutely no central authority. Critically, it fell to one man, the powerful 70-year-old banker J.P. Morgan. He had to privately organize a syndicate of bankers. He personally injected $25 million in emergency liquidity, persuaded the Treasury to deposit funds into troubled banks. He basically stemmed the panic, though couldn't entirely stop it.
It's just amazing to think a private citizen essentially had to bail out the entire financial system.
It really highlights the severity of the fatal flaw in that free banking system. The total absence of a lender of last resort.
And the economic fallout.
Brutal. Industrial production plummeted 16%. Unemployment shot up from 2.8% to 8%. Imports shrank by 26%. The big takeaway from 1907 is crystal clear. It definitively exposed this critical vulnerability. It finally paved the way for establishing a modern central bank in the U.S. It showed that sometimes, centralized intervention is a necessary evil to prevent total collapse. 2.4, the Federal Reserve Act of 1913, a compromise of power.
So the 1907 crisis basically made it undeniable. The U.S. desperately needed some kind of central bank.
The political will was finally there.
And this push for government intervention addressing monopolies, financial disorder, it fit right into the broader political mood of the early 20th century, didn't it? What we call the progressive era.
Yes, that context is absolutely key. Senator Nelson Aldrich, a powerful Republican insider, he'd studied European central banking models extensively. He proposed what became known as the Aldrich Plan.
What was the core idea?
His proposal advocated for a unified central bank that could provide emergency liquidity, be that lender of last resort, that was so clearly missing in 1907.
But it wasn't smooth sailing.
No. His initial plan was seen as way too tilted towards private banking interests. It faced significant political resistance, especially from Democrats and progressives who feared Wall Street control.
And that's where the crucial compromise came in, leading to the actual Federal Reserve Act of 1913, Another example of that contradictory story, balancing interests.
It absolutely was. The Aldrich Plan had to be revised, adapted, it evolved into the Federal Reserve Act, and this act created a truly unique public-private mixed system.
How so?
It established the Washington-based Federal Reserve Board as a federal government agency, providing public oversight. But it also created 12 regional Federal Reserve banks, incorporating private and regional input. This design was a direct attempt to balance the obvious need for a central authority with those deep-seated American fears of concentrated power, making sure the system wasn't solely controlled by either Washington or Wall Street.
So the insight here is that the Fed's unique structure, this hybrid model, it's a direct result of America's historical skepticism towards central banks.
Exactly. It forced a compromise between centralized control and decentralized regional interests. It's baked into its DNA, 2.5. Structure of the Fed, a public-private hybrid.
Okay, this brings us to how the Fed actually works today, because it's a structure that's really quite ingenious in its design, trying to balance power and expertise through this unique dual decentralization system you mentioned.
Exactly. The Fed structure is unique, absolutely. It's decentralized on two really crucial levels. First, you've got the split between federal and regional authority. 12 regional Federal Reserve banks handle local economic issues, provide services, while the Federal Reserve Board, the Board of Governors in Washington, D.C., oversees federal policy.
And the second level, the public-private thing.
Right. And this is crucial and often misunderstood. There's this public versus private hybrid nature. The regional feds are technically owned by the member commercial banks in their district, but, and this is key, they operate as nonprofit public entities.
So they're not making profits for bankers.
No, their profits are actually remitted to the U.S. Treasury. Their shareholders, the member banks, only receive a legally fixed dividend, currently around 6%. This often misunderstood hybrid nature was actually central to the misinterpretations in books like Currency Wars.
So the big takeaway is it's designed so no single interest, public or private, has complete control.
That's the goal, to prevent capture by either government or finance.
Okay, so it's not truly private in the way some people claim. Let's talk about the Federal Reserve Board itself, the Board of Governors. That's the top layer, right?
The Board of Governors is the highest governing body. It is a federal government agency directly accountable to Congress. The chair has to report regularly to legislative bodies.
And who sits on it?
It comprises 7 governors. They're nominated by the president, confirmed by the Senate, and here's a key feature. They serve very long, staggered 14-year terms. One term expires every 2 years.
14 years, wow.
Yeah. And the chair and vice chair are selected from these governors, serving renewable 4-year terms, their main jobs. Setting monetary policy tools like the discount rate, reserve requirements, supervising the regional feds and various financial institutions, maintaining overall financial stability, and protecting consumer rights.
That 14-year term for governors, that sounds like a serious safeguard for independence. It's meant to keep them out of the short-term political whirlwind, right?
It is absolutely critical. Those long staggered terms are designed specifically to shield governors from short-term political pressures, to allow them to make decisions based on long-term economic stability, not, the next election cycle.
And they fund themselves, too.
Yes. Furthermore, the Fed is self-funded. It gets revenue from interest on the government bonds it holds and from fees for services it provides to banks. This means it doesn't rely on congressional appropriations, which further insulates it from political influence.
And this is precisely what actions like Trump's public pressure and proposed reforms are trying to undermine.
Exactly. The very structural safeguards designed for independence.
Okay, and then we have the 12 regional Federal Reserve banks. How do they fit into this complex system?
These are the quasi-private, nonprofit institutions located across 12 distinct economic districts. New York, Chicago, San Francisco, Dallas, etc. Their governance structure is also pretty intricate. Each has a 9-person board of directors. And these directors are carefully chosen to represent a mix of interests. 3 are Class A directors, representing the member banks. 3 are Class B, representing the public interest, things like commerce, agriculture, labor, elected by member banks, but from outside banking. And 3 are Class C directors, appointed by the Board of Governors in Washington, also representing the public interest and specifically unconnected to banking. The C-class directors chair the board.
So a real mix.
A real mix designed for balance. The presidents are nominated by these local boards but have to be approved by the Board of Governors in Washington.
And what do these regional banks actually do?
Their main jobs involve implementing monetary policy on the ground, like issuing currency, conducting discount window operations where they lend to member banks. They also collect vital regional economic data, the stuff that gets summarized in the widely watched Beige Book reports. And they maintain critical payment and clearing systems like FedWire, which are essential for the smooth functioning of the whole financial system.
And the New York Fed is special.
Ah, yes. The New York Fed holds a unique status. It's the only regional bank with a permanent voting seat on the FOMC, the main policymaking body. And it's responsible for carrying out open market operations, buying and selling treasury securities, and for foreign exchange intervention. So, yeah, it's uniquely influential.
Okay. And the final piece of this really complex puzzle, the committee that actually makes the calls on interest rates in QE/QT, is the Federal Open Market Committee, the FOMC.
That's right. The FOMC is the main engine room for monetary policy. This is where the critical decisions on the target for the federal funds rate and operations like QE or QT are actually made.
Who's on it?
It's composed of 12 voting members. All 7 members of the Board of Governors have permanent votes. The president of the New York Fed also has a permanent vote.
Huh.
And then 4 rotating presidents from the other 11 regional Federal Reserve banks serve one-year terms as voting members.
So the other regional presidents attend but don't vote.
Exactly. They attend the meetings, participate in the discussions, provide the regional insights, which is crucial, but they don't get a formal vote unless it's their turn in the rotation.
And how often do they meet? How do decisions get made?
The FOMC holds 8 regularly scheduled meetings each year, though they can meet more often if needed. Decisions are made by a majority vote, so it requires at least 7 votes to pass a policy change. The chair, currently Powell, wields significant influence, setting the agenda, guiding the discussion, often drafting the initial proposals.
Which is why actions like Trump's targeting of appointments to the Board of Governors are so significant.
Precisely, because those governors make up the majority of the FOMC. Influencing the governors directly aims to influence these critical policy decisions that affect every single one of us. 2.6. The church analogy, a quirky perspective on the Fed's hierarchy and internal divisions.
You know, it is such a complex, almost, I don't know, arcane structure. It can be hard to wrap your head around, let alone explain clearly. But I read somewhere, I think it was in that book, The Federal Reserve, that a former Boston Fed vice president, who'd also been a special assistant to the Fed chair, had this rather amusing but actually quite insightful analogy.
Ah, you must mean the church analogy.
That's the one. He compared the Fed structure and how it operates internally to the Roman Catholic Church.
It's surprisingly apt, actually, and it does help make sense of the internal dynamics, the power structures, the different schools of thought.
How does it break down?
Well, in this comparison, the Fed chair is like the Pope. The governors on the board and the regional Fed presidents are the cardinals. The senior staff, the economists and advisors, they form the Senate, maybe the Curia.
Okay, and the banks.
Commercial banks are the regular parishioners, receiving guidance and regulation. And crucially, within the Fed itself, the different ideological factions, the monetarists, the New Keynesians, the Doves, the Hawks, they're likened to the various religious orders, like the Jesuits, the Franciscans, the Dominicans, each with their own interpretations, their own approaches to achieving monetary salvation, so to speak.
Huh. That makes a lot of sense, actually, especially when you think about the internal debates, the different economic philosophies clashing, and maybe even the perceived mystique of central banking, this almost sacred duty they perform.
It really does capture it well. What's fascinating is how the analogy highlights not just the hierarchical power structure, but also these constant internal ideological debates that genuinely shape policy. Just like debates within the church shape doctrine, these factions within the Fed have differing views on how to achieve stable prices and maximum employment. And those debates directly influence the policy direction.
And especially after the dollar came off gold.
Exactly. After the dollar decoupled from gold, the Federal Reserve effectively became the ultimate source of monetary credit, didn't it? So in that context, its policy decisions, its creation ritual of money, takes on this certain quasi-mystical significance, which the church analogy captures rather well, I think. The big takeaway is that it helps us understand how it works, beyond just the org chart. It gets to the human element, the internal culture, the beliefs driving policymaking. 2.7, evolving mandates. From last resort lender to all-encompassing guardian.
So the Fed was born out of crisis, forged in compromise. But its role didn't just stay static after 1913, did it? Its mandate, its functions, they've dramatically expanded over its century-plus history, constantly adapting to new crises, new societal needs. It really is a contradictory story of ever-growing power and responsibility.
That's a perfect way to sum it up. In its founding era, say from 1913 to the 1930s, its primary function was relatively simple: act as a lender of last resort.
Stop the panics.
Exactly. Its core job was to stabilize the banking system, provide an elastic currency, meaning it could expand or contract the money supply as needed to prevent those devastating bank runs we saw in the free banking era. And practically, it established a national check clearing system. Its monetary policy tools were pretty limited back then, mainly just adjusting the discount rate, the rate at which it lent to banks. It was designed to solve a very specific critical problem.
Then came the Great Depression. I imagine that changed absolutely everything about how the Fed operated and what people expected from it.
Profoundly. The Great Depression and the subsequent post-war period, say the 1930s through the 1950s, saw the Fed's power expand significantly, and its regulatory role really strengthen.
What were the key changes?
Well, the Banking Act of 1935 formally established open market operations, buying and selling government securities as the main tool for policy, and formally created the FOMC as the decision-making body. That gave it a systematic framework for setting interest rate policy. The Fed also gained authority to supervise bank holding companies and played a crucial role in designing the Federal Deposit Insurance System, FDIC, to prevent systemic risk.
And its independence got cemented, too.
Critically, yes. The 1951 Fed Treasury Accord ended the World War II era practice where the Fed essentially had to keep interest rates low to help the Treasury finance the war debt. This accord solidified the Fed's monetary policy independence from the Treasury's borrowing needs. The big takeaway here is that this period really defined how it works as an independent entity, free, at least in principle, from direct government financing dictates.
But the real turning point, the moment that forged the modern Fed we think of today, seems to be the 1970s and 80s, the era of the great inflation and the legendary Paul Volcker. This feels like a truly transformative story for the Fed.
Oh, absolutely pivotal. The 1970s were a nightmare economically. Two major oil crises, stagflation, that toxic mix of high inflation and high unemployment. This crucible transformed the Fed into an aggressive inflation fighter, and this era gave us the legend of Paul Volcker.
Tell us about him.
Appointed Fed chair in 1979 by President Carter, Volcker inherited an absolute economic crisis. Inflation running at 15%, unemployment over 10%, gas rationing, a plunging dollar. Volcker, this towering figure, 6'7", an economist, Wall Street veteran, known for his bluntness and that ever-present cigar, he fundamentally believed that inflation is the #1 enemy, and it had to be crushed no matter the short-term pain. He famously said something like, "Inflation is like toothpaste. Once you squeeze it out, you can hardly get it back in again."
And he didn't pull any punches, did he? His shock therapy was incredibly tough and highly unpopular at the time.
Brutal is the word. Volcker aggressively jacked up the federal funds rate from around 11% to over 20%. Simultaneously, he implemented strict money supply controls, targeting bank reserves directly to force banks to cut back on lending. The immediate pain was immense. Businesses failed, unemployment surged, hitting 10.8% by 1982. Farmers, furious, famously drove their tractors to the Fed's headquarters in protest.
He must have faced incredible political pressure.
Immense. Even from President Reagan, who privately urged him to cut rates before the '82 midterms. Volcker's retort to Reagan became legendary. Do you want inflation or an election? He was just unwavering in his mission, laser focus.
But his victory in the end was undeniable, and his actions really set the stage for decades of relative economic stability and growth afterwards.
Indeed, inflation plummeted from that 15% peak down to 3% by 1983. He restored the dollar's credibility. And yes, it arguably paved the way for the golden decades of low inflation and high growth that followed in the 80s and 90s, a period when investors like Warren Buffett really prospered.
So his legacy.
Volcker's actions became a textbook case for central banks globally. It demonstrated the critical necessity of central bank independence, especially when facing immense political heat. He became a kind of spiritual idol for future Fed chairs like Greenspan, Bernanke, and Powell. The big takeaway here is that Volcker's painful victory solidified a core insight for central banks everywhere. True independence often requires unpopular, even brutal, short-term actions for long-term stability. It's a lesson that still echoes in today's inflation fights.
And the Fed started looking outwards more, too.
Yes, this period also saw increased international coordination. The 1985 Plaza Accord, where the Fed collaborated with other major central banks to manage the dollar's exchange rate, marked its real entry into governing the global currency system. And internally, policy frameworks like the Taylor Rule were introduced, linking interest rate adjustments more explicitly to inflation and employment gaps, trying to increase policy transparency.
Wow. So from that era of the disciplined, tough inflation fighter, the Fed evolved yet again after the 2008 global financial crisis, becoming what some might call an all-powerful central bank, maybe even a financial savior. This really is a contradictory story of ever-expanding responsibility and power.
Precisely. The 2008 GFC pushed the Fed into completely unprecedented territory. Its toolkit expanded far beyond just being a lender of last resort to banks. It provided emergency loans to non-bank institutions, like the giant insurer AIG, to prevent systemic collapse. It created 11 brand new liquidity facilities to stabilize the entire financial system.
And then came QE.
Quantitative easing. The Fed started massively purchasing government bonds and mortgage-backed securities. Its balance sheet exploded, going from around $900 billion before the crisis to eventually over $6 trillion. This directly influenced long-term bond yields. It was a radical departure from traditional central banking.
And these actions had massive global implications, right? It really feels like no snowflake is innocent in this interconnected financial world anymore.
Immense implications. This era also ushered in a new focus on macroprudential regulation. The 2010 Dodd-Frank Act empowered the Fed to supervise systematically important financial institutions, the too-big-to-fail firms, and established the Financial Stability Oversight Council. This shifted the focus from the risk of individual firms failing to the risk of the entire system destabilizing.
And the spillovers.
Huge global spillovers. QE led to massive capital inflows into emerging markets between roughly 2010 and 2013, over $1 trillion annually flowing into EMs. You saw Brazil's and India's stock market soar over 50%. The Brazilian real appreciated 40%. Turkey's external debt relative to its GDP jumped from 30% to 50%.
But what goes up?
Must come down. When Fed Chair Bernanke merely hinted at reducing or tapering QE in 2013, it triggered the infamous taper tantrum. Capital rapidly reversed course, flowing out of emerging markets. Currencies plunged. The Indian rupee, the Brazilian real fell over 10% in a single month. Bond yields spiked in countries like Indonesia and Turkey by 3 to 5 percentage points. It showed how dependent the world had become on Fed liquidity.
And we've seen similar patterns more recently, haven't we? With the post-pandemic rate hikes, the Silicon Valley Bank collapse, even things like Sri Lanka's national default. The ripple effects are undeniable.
Indeed. The big takeaway from this whole evolutionary journey is that the continuous expansion of the Fed's power seems to be a direct response to successive financial crises. Each crisis demands a savior, and that savior incrementally takes on more roles, from providing liquidity to sanitizing bad assets to implementing macroprudential regulation to coordinating globally. The Fed's evolution path, you could summarize it as born in crisis, balanced in compromise, transformed by expansion, and maybe made omnipotent by globalization. It's a story of dynamic adaptation to these major contradictions within the financial system itself. 3. The current crossroads. New realities and global differences.
Okay, so we've traced this incredible, often contradictory journey of the Fed from this hesitant experiment born of panic to this global financial behemoth. But what about right now? We seem to be at a really pivotal crossroads, facing new realities, unique challenges, especially when we look at inflation expectations. 3.1, shifting sands of inflation expectations, a return to the 70s.
Well, what's deeply concerning right now and a potential game changer is this significant and seemingly sustained shift in long-term inflation expectations. It could really signal the end of a 40-year trend.
40 years of falling expectations.
Pretty much. For 4 decades, U.S. long-term inflation expectations, the ones measured by surveys like the University of Michigan Consumer Survey, they steadily declined from a high of nearly 10% back in 1980 down to about 2.5% in 2019. But since 2021, these expectations have been creeping up, reaching 3–4% in 2025. That's the highest level since 1992.
Wow. So that's a critical development for monetary policy, right? A significant bug in the current environment.
It is, absolutely. Because when inflation expectations are low and anchored, central banks have more wiggle room. They can afford to be a bit more lenient with short-term supply shocks, assuming they won't translate into persistent inflation.
But if people expect inflation to be higher for longer?
That changes everything. Rising long-term expectations carry the significant risk of triggering what economists call a second-round effect, or worse, a wage price spiral. That dangerous positive feedback loop where higher prices lead to demands for higher wages, which then push prices even higher. Very much like what we saw painfully back in the 1970s. Once that flywheel starts turning, it's incredibly difficult to stop.
So it's almost like a path dependency problem.
Yeah.
Past assumptions about low inflation just don't hold true anymore.
Exactly. And the big takeaway here, I think, is that the Fed's somewhat delayed reaction, waiting until 2022 to start hiking rates aggressively, despite inflation surging past 10% in 2020-2021. That arguably reflected an outdated approach based on those now obsolete low inflation expectations. This fundamental shift requires really careful adaptation from policymakers and, frankly, from investors, too. 3.2, Powell's cautious stance at Jackson Hole 2025.
Speaking of adaptation, let's loop back to Chairman Powell's recent comments at Jackson Hole 2025, which kicked off our whole discussion today. His remarks seemed really nuanced, did they? They kind of embody this idea of systematic insight, diversified adaptation that we tried to champion on the show.
Indeed. Powell's statements were definitely layered, requiring some careful parsing. First, on the labor market, he noted that while it looks balanced on the surface, no big spike in unemployment, he called it a fragile balance.
Fragile how?
Because it seems to be due to weakness on both sides. Labor supply is constrained, partly due to immigration restrictions maybe, but labor demand is also weak. So what looks like stability might actually be a precarious equilibrium just waiting to tip.
Interesting. What else stood out?
Second, and this was a subtle shift, he expressed an inclination to view potential tariff increases as more of a one-off price shock, not something that would necessarily lead to that second-round inflation effect or a wage price spiral.
Which is different from previous, more hawkish statements.
Slightly less aggressive, yeah. It suggests maybe a slightly less worried inflation outlook than before.
And his overall tone, it seemed to be tempering expectations for big, drastic moves.
It really did. Compared to his talk of definite easing about a year prior, his current remarks signaled more of a cautious easing approach, which supports market expectations for rate cuts to maybe begin by September 2025. But it also suggests these cuts probably won't be super deep or sustained.
So the market pricing in rates falling to 3% within 2 years, maybe a bit optimistic.
Potentially. Powell's nuance certainly tempers expectations for overly aggressive cuts. He also kept emphasizing that interest rates are currently at a restrictive level, meaning they are actively restraining the economy. Yet he also noted the economy remains surprisingly strong.
Like the horse is harnessed, but still running wild.
That's a good analogy. It implies the horse is harnessed, yes, but it's still running wild, quite possibly fueled by these large U.S. fiscal deficits we talked about.
So the big takeaway is this dynamic tension. Restrictive monetary policy fighting against expansionary fiscal policy.
Exactly. And that's a major bug in the system right now. It complicates the Fed's job immensely and makes outcomes much harder to predict. 3.3. Central banks around the world. Different goals, different constraints.
It's easy sometimes to just lump all central banks together thinking they operate under the same rules. But that's really not the case, is it? My sources mentioned that way back a century ago, the Fed's structure was actually quite unique in its independence compared to other big industrial nations.
That's true.
Places like the UK, Japan, France, Italy. Their central banks were often much more directly subservient to the elected government, sometimes needing the prime minister's okay just to change interest rates.
Right. Germany's Bundesbank was a rare exception back then, much more like the Fed in its independence.
So I'm curious, 100 years later, do these fundamental differences still hold? And how do they actually impact outcomes for national economies, for global markets?
That historical observation still largely holds true today, although the landscape has certainly evolved. The key differences among major central banks now are primarily in their official policy mandates and the unique ways their monetary policies actually transmit through their respective economies.
Can you give an example? Mandate differences.
Sure. Take the European Central Bank, the ECB. Its primary mandate is focused almost exclusively on inflation targeting. That's a direct legacy of Germany's historical obsession with price stability, post-hyperinflation.
Okay, ECB inflation fighter. What about the Fed?
The U.S. Federal Reserve, as we know, has that dual mandate, maximum employment and price stability. So it's juggling two balls.
And China? Japan.
China's central bank, the PBOC, and the Bank of Japan, they also often pursue dual objectives, things like full employment and price or currency value stability. But and this is a key difference, they frequently operate under much more significant political influence than the Fed, which can really impact their perceived independence, even if they have formal independence on paper.
So even their fundamental goals can differ, leading to very different priorities day to day. What about how their policies actually work in practice, especially when a government gets into fiscal trouble?
Right, the monetary transmission mechanisms, how a rate hike actually affects borrowing, spending, inflation in the real economy, they differ greatly. Depends on the structure of the banking system, the depth of financial markets in each country.
Give us a current example. France seems to be in the headlines.
France is a vivid illustration right now of how these constraints bite. They're facing significant fiscal woes. In 2024, France's fiscal deficit was 5.8% of GDP, projected to hit 6.3% in 2025. That's way over the EU's strict 3% limit. And its public debt is also really high for the Eurozone, about 114% of GDP.
So the government tries to cut spending, raise taxes.
And they face massive political opposition, strong resistance from both left and right-wing parties, leading to votes of no confidence. Their former prime minister got impeached. The current one's facing multiple challenges. It's politically gridlocked.
That sounds like a really tough spot for France, especially given what you said about the ECB's mandate.
This situation highlights the critical difference. The ECB, unlike the U.S. Fed, operates under these strict EU fiscal rules, the Stability and Growth Pact. Those rules prevent it from directly financing individual member state deficits. There's no central bank ATM for France to just tap to absorb its debt easily.
So what happens?
Well, the big takeaway here is that this leads directly to bond market volatility. French bond yields rise relative to German ones. The stock market gets nervous. Investors perceive higher risk because there isn't that central bank backstop readily available in the same way there might be in the U.S. It's a stark illustration of the dangers of high fiscal deficits without direct central bank support. It really emphasizes how these key differences in mandates and constraints dramatically impact outcomes. It's just a fundamentally different way Europe tackles fiscal problems compared to the U.S. 3.4. Modern Monetary Theory, MMT, a controversial solution to fiscal challenges.
Okay, given all these fiscal challenges we're seeing both in the U.S. and abroad, this controversial economic theory has been gaining a lot more attention lately. Modern monetary theory, or MMT.
Ah, yes, MMT. Definitely getting more airtime.
It really seems to challenge the traditional views on government spending and debt, doesn't it? And it feels very relevant to this whole losing anchor world we're discussing.
It does feel relevant, yes. MMT's core tenets, basically, argue that governments that issue their own sovereign currency, like the US, UK, Japan, are not budget constrained in the same way a household or a business is. They literally cannot run out of money that they themselves create.
So they can spend whatever they want.
Not quite. MMT posits that the true constraint on fiscal expansion isn't the deficit number itself, but rather inflation or real resource scarcity. So, from this perspective, central banks can, and maybe even should, directly finance government spending by creating money, as long as doing so doesn't trigger excessive inflation. It's like saying, if you control the printing press, you can always pay your domestic bills.
That sounds a lot like that idea that internal debt isn't really debt, doesn't it?
Yeah.
You know, the country just owes money to itself, so it's not a real problem.
It's very closely related to that idea, yes. However, MMT faces some pretty significant criticisms.
Such as?
Well, critics argue it tends to neglect the role of market expectations and the potential long-term risks associated with ever-increasing government debt, even if it's domestically held. Critically, many argue it inevitably weakens central bank independence over time.
How so?
If markets start to anticipate that governments will just routinely print money to finance spending, it could trigger precisely that wage price spiral we talked about earlier. Rising inflation expectations could become a self-fulfilling prophecy. Ray Dalio's work, like in Why Nations Fail, offers a stark counterpoint, arguing that long-term reliance on debt monetization ultimately leads down one of two disastrous paths, either hyperinflation through money printing and currency devaluation, or eventually some form of default.
Okay, so given these pretty serious risks, is MMT just a theoretical curiosity, or are we actually seeing countries moving in that direction? I mean, could France's deficit problem just be solved by the ECB buying up its bonds under some MMT framework?
Well, in the Eurozone, as we just discussed, the ECB's hands are really tied by those strict fiscal discipline rules. It cannot directly finance member state deficits in that MMT-like way within the current framework. That's precisely why France is struggling and facing market pressure.
But outside the Eurozone.
This is the significant point for you, the listener, to understand. Major world economies, specifically the US, China, and Japan, seem to be almost unavoidably sliding towards more MMT-like practices. Not necessarily because they suddenly embrace the theory wholeheartedly, but more out of perceived necessity due to the challenges they face.
Like what?
While the US has these persistent large fiscal deficits that require massive funding year after year, China is facing falling private sector demand, which means the government feels compelled to borrow and spend to stimulate the economy. Japan, with its high savings rates and decades of asset deflation, has long relied on massive government borrowing, largely absorbed by its own central bank, to avoid even deeper economic stagnation.
So while all these major countries are increasing their debt, the immediate outcomes might vary depending on other factors. It's not automatically a one-size-fits-all disaster scenario.
Exactly. The context matters. For instance, China's currently low private sector demand might mean government borrowing can be more easily digested without triggering immediate inflationary pressure compared to, say, the US, where demand might be stronger. The outcomes aren't uniform, but the trend towards relying more on government debt, often facilitated by central banks, is pretty clear.
So the big takeaway.
The big takeaway here is that we seem to be entering, or maybe are already deep into, an era where major nations are increasingly relying on government borrowing, often financed directly or indirectly by their central banks, as a primary tool to manage economic stability. This carries profound long-term risks to currency credibility and has huge potential implications for wealth redistribution. It's a critical aspect of this losing anchor fiat money world and something every investor really needs to get their head around. 4. Navigating the losing anchor fiat world, impact on your wallet and investment strategy.
Okay, this brings us right to the bottom line, the ultimate question for our listeners. How do we actually navigate this losing anchor fiat world that seems to be unfolding all around us?
Right.
What does it truly mean for your wallet, for your investment strategy, when the very foundations of the global financial system seem to be shifting under our feet? 4.1. The Fed's global dominance and its shifting foundations.
Well, traditionally, the Fed's policies have been globally dominant, haven't they? Because its interest rates effectively serve as the global risk-free benchmark rate. That influences investment decisions, asset valuations all around the world.
The anchor.
The anchor, exactly. And any significant financial turbulence often coincides with a rising dollar liquidity premium, a sign that investors are scrambling for dollars, signaling decoupling or blockages in the global financial plumbing. That's a clear bug when it happens. However, the very foundation of this dominance, the perceived risk-free status of U.S. government debt, seems to be eroding.
And this isn't entirely unprecedented. You mentioned earlier the U.S. has kind of defaulted before. That sounds pretty shocking given its current reputation.
It has, though in a way that's legally quite fascinating and often forgotten. Back in 1933, President Franklin D. Roosevelt signed legislation that abolished the gold clause in U.S. government bonds, as well as private contracts.
The gold clause.
Yeah, this clause allowed creditors to demand repayment in gold at a fixed rate, which was then $20.67 per ounce. FDR effectively nullified that contractual right. Then, the very next year, 1934, the U.S. officially repegged the dollar to gold at $35 per ounce.
So a massive devaluation against gold for anyone holding those bonds.
Effectively, yes. A devaluation of about 40% against gold. And get this, in 1935, the Supreme Court actually ruled that abolishing the gold clause was a breach of contract for government bonds, but then it denied compensation to the creditors, basically saying they hadn't suffered actual damages because dollars were still legal tender.
Wow, legal games indeed.
Legal games indeed. And the big takeaway here is that this historical event shows the kinds of maneuvers that are possible. It sets a precedent, however distant, for how governments can manage overwhelming debt burdens by redefining their obligations, even retrospectively.
And those current threats you mentioned earlier, things like the Mar-a-Lago Accord or those great American law proposals, they hint at potentially similar drastic moves today, don't they? Forcibly converting U.S. debt, reevaluating foreign investment.
Precisely. These aren't mainstream proposals right now, but the fact they're even being discussed highlights a shift. They represent significant potential threats, particularly to foreign investors holding U.S. debt. It suggests that U.S. Treasury bonds are perhaps no longer perceived as truly, unequivocally risk-free by some global investors.
So what's the consequence?
Well, as a result, we're already seeing subtle but persistent signs of global investors increasingly diversifying away from purely dollar-denominated assets. Central banks accumulating more gold, exploring alternative reserve currencies. This gradual shift challenges the Fed's unchallenged global dominance and is a clear indicator that this losing anchor world isn't some distant future possibility. It's arguably the present reality we're living in. The dollar's role as the sole undisputed global reserve currency is under a quiet but persistent challenge, and that impacts how markets function and what investors perceive as truly safe. 4.2. Navigating the losing anchor world. What to watch and how to adapt.
Okay, so if the old anchors are truly gone, or at least dragging, how do we interpret market signals now? What should we as listeners be watching most closely to help us adapt our long-term wealth preservation strategies in this losing anchor world?
That's the key question. In this new environment, just watching U.S. interest rates, the traditional benchmark, probably isn't enough anymore. Investors now need to closely monitor at least two other critical indicators: the U.S. dollar exchange rate against a basket of currencies, and crucially, gold prices.
Why those two specifically?
Because they provide vital signals about broader market sentiment towards U.S. policy credibility and the dollar's long-term standing. If you see the dollar consistently weakening despite maybe Fed tightening, or if you see gold prices strengthening persistently, that indicates a growing lack of trust in traditional fiat assets and a search for alternative stores of value. That combination, a weak dollar and strong gold, that's becoming a really important compass in this shifting landscape.
You've often talked on the show about the fundamental nature of currency itself, how it's created through credit and circulation, and how it can perish when that credit ends. How does that understanding help us navigate this specific moment?
It's fundamental, I think. Money, at its core, is created through the extension of credit and the circulation that follows. And its value, its existence really, is tied to the perceived viability of that credit. In a world where maybe real economic credit from the private sector isn't strong enough to drive the growth we expect, government borrowing and deficits almost become necessary just to maintain economic balance, to keep the system circulating.
But that has consequences.
It inevitably leads to a form of wealth redistribution, often subtle, as the value of existing currency shifts relative to real assets or other currencies. Furthermore, we have to remember that wealth isn't static. It's not just a number on a screen. It's a flow, a dynamic construct constantly changing value based on demand and exchange within a community. Your wealth's market value is ultimately determined by what others are willing to exchange for your assets, not by some inherent static quantity you possess. Understanding this fluidity is absolutely key to adapting.
So what does this mean concretely for our investment strategy in this environment, this kind of magic realism of the ongoing situation, as you called it before? You've offered some anti-fragile asset allocation ideas in previous deep dives. How do they apply specifically to navigating this losing anchor world?
Those principles remain highly relevant, I believe. In fact, they're almost tailor-made for this kind of uncertain environment. First, gold. It remains a crucial safe haven asset in times of systemic stress or chaos. It provides a hedge against potential dollar credit risk, against the possibility of the dollar weakening further as a reserve asset. It's a tangible asset that tends to hold value when trust in paper assets wavers.
Okay, gold first. What else?
Second, we've discussed Chinese assets. The investment logic there is based on potential confidence recovery from very low levels, the valuation gap between A shares and H shares, and the possibility of policy dividends from government stimulus as China navigates its own significant economic transitions. And actually, their performance, since we discussed them back in April, has exceeded expectations, showing the potential power of diversified adaptation away from just traditional developed markets.
And third,
at the time, we suggested the Japanese yen as a potential short-term safe haven choice, or at least a diversifier. The logic was based on Japan's large trade surplus, nascent signs of rising domestic inflation after decades of deflation, and the potential, however slow, for the Bank of Japan to finally start normalizing its own ultra-loose monetary policy, which could support the yen.
So the big takeaway here is that these strategies are all about diversifying, adapting, looking beyond the traditional playbook.
Exactly. It's all about diversified adaptation in a world where those traditional risk-free assets are becoming demonstrably less so. You need to look beyond the obvious, understand the global flows, and build a portfolio that's resilient to a wider range of potential outcomes.
It really comes back to understanding that wealth is this dynamic, almost communal construct, doesn't it?
Yeah.
And we need to be agile, diversified in our approach, constantly reading the subtle signals of a changing financial world. Outro.
So, this deep dive, I hope it's shown that the Fed's 100-year history is far, far from being some dry economic textbook chapter.
Definitely not more like a gripping drama.
Right. It's a dramatic narrative filled with power struggles, ideological compromises, and this constant, almost relentless adaptation. From its beginnings as just a lender of last resort trying to stop panics, to its current, almost all-encompassing role as a multifunctional global financial steward. Its actions, whether interest rate decisions or quantitative measures, they profoundly impact global economies and, yes, ultimately, your personal finances.
Indeed. It's been quite a journey we've traced. From crisis to compromise, from expansion to becoming this, well, omnipotent global entity, as you put it. We've seen how deep human philosophies, from Hamilton's federalism to Jefferson's agrarianism, have genuinely shaped the evolution of monetary policy over centuries.
We've explored how that unique public-private hybrid structure of the Fed actually works on the inside.
Identified some of the current bugs like political interference, the tension with fiscal policy.
And recognize the crucial differences among central banks worldwide that create these complex, often unpredictable global dynamics.
Absolutely.
And as we wrap up, we want to leave you, our listener, with maybe a provocative thought to mull over. We live in this world where wealth feels like it's in constant flux, defined maybe less by static accumulation and more by our relationship with the collective, with the flow of exchange. So what does wealth freedom truly mean to you in that context?
That's a deep question.
Is it just an endless pursuit, an endless accumulation of assets? Or could it be a state of maybe desiring less from others, thereby needing less from the system to achieve your own personal fulfillment? Perhaps true freedom isn't found in infinite wealth, but in acquiring the appropriate amount, whatever that means for you, that allows you to pursue your self-defined needs and desires, rather than being constantly driven by the ever-shifting demands and anxieties of the market.
A shift from seeking to control wealth to understanding its flow and embracing maybe
Yeah.
appropriate needs.
Something like that, a different perspective, perhaps.
That's a powerful thought to chew on. Before we go, we always like to offer a few book recommendations for those who want to dive even deeper into this fascinating, complex world.
Yes, definitely. From my side, I'd recommend Restoring the Real Federal Reserve by Wang Jin. The author is a former insider at the New York Fed, I believe, and it offers a really accessible account of the Fed's actual operations. And for a completely different critical perspective, maybe The Mystery of Banking by Murray N. Rothbard, it provides a classic Austrian School of Economics viewpoint on commercial banking and central banking.
Great suggestions.
Yeah.
And I'd strongly suggest The Federal Reserve by William Greider. He was a veteran financial journalist who spent years essentially embedded with the Fed back in the Volcker era, interviewing everyone from the chair down to the regular staff economist. It's just a compelling narrative-driven read that truly pulls back the curtain on this often mysterious institution.
Kreider had some great lines in that book, didn't he?
He really did. Capturing the drama, like Wall Street slapped the president, or describing the Fed itself as a complete freak because of its unique structure. It reads like a captivating story, not a textbook, offering real insight and humanizing this incredibly powerful institution. Definitely worth a read.
Well, thank you for joining us on this deep dive into the Fed. We hope you've gained some systematic insights into its intricate role in our interconnected financial world.
And feel maybe a little better equipped to adapt your perspective and your strategies in this, well, losing anchor fiat world. Until next time.